What's up, guys? It is Sunday, August 25th, and I'm looking at ways to put capital to work, how to save money, how to make money, what's going on in markets. There's some stuff I found that I just had to show you guys because it's too good not to share. As always, we're going to be jumping around, so feel free to skip if you want to skip around. We've got the world of private equity, private credit, and the world of alternative investments to kick things off. Then we're going to be looking at some data, deal flow, exit planning, exit strategies, exits that we've actually seen from VCs, founders, and in the private equity world, and that M&A activity out there. We're going to be looking at the concept of putting money to work because I've seen some stuff out there that's a little bit misleading. Then we're going to have to get into the state of politics because, boy, I don't know what the heck's going on in this country, in this world. Do you see who's that? The guy from Telegram got arrested in France. I mean, woof. It's not just America that's getting a little bit wacky. And then we'll be closing things out looking at public markets. We got Nvidia's earnings this week, and we'll check in what's going on with the Magnificent Seven, what's going on with the rest of the market, small caps, mid caps. Let's dive in. Okay, starting with some headline news, and if you've seen this before, that's right. I made a video about the state of capital markets. You can go check it out. So this is not being lazy. Sometimes it helps to be repetitive. When there's a really good and important idea, sometimes you need to reinforce it. Okay, so this is private capital groups hit and hope in rush to deploy billions. Okay, so this is August 6th. It's been what, 3 weeks? Not even. So this was the volatility. There was the Japanese yen carry trade that was unwound or partially unwound. And now 3 weeks later, 2 or 3 weeks later, we're back up to all-time highs. And the point here from a private market and the capital market perspective is this is an article like this is a leading indicator. It takes time to get this money into the system. Once you pay the bill, once the money changes hands, it doesn't necessarily have any impact till later on. So keep this in mind. Private groups are getting capital and they're putting that money to work. Here's another one with Ares, their private credit fund. This was a record, I believe, 34 billion. That's the largest private credit fundraising or fund that's been initiated. And now that they've got that money raised, they can put it to work elsewhere. And then this is the big one, seeing 160 billion with a B. That's Ares, Apollo, Blackstone, KKR, and I'm sure plenty of the other medium to smaller guys. They want to put money to work. Prepare for deal revival. This was August 3rd, so it's been 3 weeks. Okay, it doesn't happen overnight. They got money to spend. They're not just going to find the first thing they can throw it at. So keep an eye out. Deals are going to start getting done. That money's going to work its way through the system, and you should see things start to turn up and get a little bit spicy out there in the world of private credit, private equity, and these alternative assets and investment classes that tend to outperform public equities and be less volatile if you end up seeing a sell-off. All right. We've got fundraising data here in private equity from 2018 through the first half of 2024. A couple of things I wanted to point out here. The number of closed funds in blue, the aggregate capital raised, these green lines you can track here, and then the average size of the deal in orange. So first, just looking at the number of closed funds, you can see we've leveled off here. We had those good runs 2020, 2021, and then trailed off in 2022 as markets corrected, but still a lot of activity in 2022. And the average size of the deals were ticking up. Big time numbers getting higher and higher in the deal size, even as the number of closed funds was trailing off. So that was interesting there. And still a good amount of capital being raised as there was the sell-off. And now we're kind of, you could call it a mean reversion here, 2024 looking more like these prior years, but even still, we're below where we were in 2019 and 2020 in terms of the number of closed funds. And I just think it's a complicated environment. It's hard to make deals work. It's hard to get the numbers to pencil. You could compare this a little bit to what's going on in real estate, where people call it supply and demand imbalances, or people think they got the golden handcuffs. They're locked in at their 2 or 3% mortgage. They don't want to do anything. You see some similarities here, but the deal size trailing off here. What I think is happening though is this the aggregate capital raised, like we just saw a moment ago. I think we're going to start to see these numbers start to pick back up, and we're going to see more of a direct correlation. This aggregate capital raise, I think we're going to bottom around here, start to tick back up. The number of closed funds as interest rates start to come down and capital becomes easier to access. I think we're going to see these blue bars tick back up. And we should see this orange, the average size of the deal should level off here. So that's going to be something to keep an eye on. The private equity deal activity. Okay, so we're looking at deal value and deal count in the top one. The slowdown in private equity exits that started in 2022 extended into 2024. Sponsors waited for more favorable market conditions to sell. So another one where I see similarities to the world of real estate, where we're stuck right now, and as rates come down, people think the price of real estate is going to boom, but actually, as that supply comes online, you might actually see rates coming down and the prices coming down too. It could be similar here. It may not be. That's just a prediction to kind of play devil's advocate on my previous point, but we will see. We're still above where we were in some of these 2019, 2020 times, but not by much. We're just hanging on here. Fortunately, well, not fortunately, depending how you look at it, deal count is up in the past year or so, whereas the deal value is similar to before. So more deals, but people really hunting for scraps out there. And hopefully that's going to turn around because private markets play a big role in the grand scheme of things. Okay, and then in terms of the exit activity, this is really trailing off here, aggressively trending downwards in terms of the amount of exits. The exit value is decent, more or less, for the past several years. Is pretty steady here, above 70, at least as an average. We've seen 55, 62, 56, but for the most part, around 70-ish. And I am starting to feel like with the amount of capital being raised in private credit and private equity, that we're going to start to see more M&A, more deals, more transactions, and these numbers should start to tick up as rates come down. And then in the middle markets, so this is from PitchBook here, this one, we don't have 2024 coming online yet, but similar trends where it was a good decade, 2010 to 2020, it was taken up, 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 up. That 21, 22 started to come back down and the deal value started to come back down, but a lot of deals, so the amount of deals is trending upward. It's just not the big sizes that we got used to. And if deals keep getting done and the deal value comes back up, then that is going to be a nice trend out there. One of the reasons I'm calling for seeing an uptick in deal activity and for putting money to work is that you want to be early, particularly in the private market, where if you get an attractive valuation and you are ahead of the curve, then you can ride that momentum. You make your life easier. And I just don't see this as being sustainable when we're looking at the graduation rates from seed to Series A. They've fallen dramatically, and this is from 2022. But the data tracks with everything we've just looked at, so we can forecast it to look relatively similar with the decreasing rates of graduation into 23 and into 2024, and it's just not sustainable. And when private markets are not participating meaningfully in the public market rallies, then eventually that divergence, what we would say is the jaws will close. Okay, so seems like a pretty decent time to put some capital to work. And then I don't know why this was on my mind, but I saw it and it really got me thinking, man, do you guys remember WeWork? We have an office there. We work, no pun intended, at WeWork. And every time I'm in there, when the paper jams or I can't scan something or I have a bad cup of coffee and I just think, well, no wonder this place blew through $100 billion. Man. But when you think about putting money to work, boy, SoftBank got in there at their peak valuation of $47 billion, and they were bankrupt. What was it? A year later, they postponed the IPO, and then next thing you know, boom, they were done, man. That is so crazy. But it just goes to show these things that seem like they can't miss. They're absolute slam dunks. You never want your eggs all in one basket. You need to diversify. And this guy, I forget his name. Well, we'll give him a break here. We won't rip him apart. I'm sure he's had his troubles, but uh, he's managed to secure generational wealth. It's kind of a don't hate the player, hate the game type of situation. But for the business owners out there, as deal flow starts to come back online, if you have an opportunity to get a premium valuation of your business, never the worst idea to take a few chips off the table. Thing we've been working on that we're excited to share with some of our private clients is our model portfolio, where we like to have about 8 or 12 different assets, different investment types that are generally diversified and non-correlated. And the reason we do it is because we want to always be in a position of relative strength, whatever happens in the market, whatever happens to the business cycle, economic cycle, whatever. Because there are exogenous events that are outside of our control, whether it's politics or virus or war, whatever it may be. Sometimes through no fault of your own, you're in a position of weakness if you weren't diversified and hedged accordingly. I've been seeing this one, the S&P in gold terms, and people saying, sure, we're at an all-time high now, but we're actually lower than we were in 1970, which is quite a mathematical statement to make. Hold on, here's another one. 10 of these in 1929, 10 of these in 2024 would buy you a house. And I like gold. I'm wearing a gold chain as we speak right now. I'm a fan. I was just talking to my wife about don't buy a Rolex. We should get more jewelry instead. um, the point here is this is just not really in line with economic and monetary theory, because if you put 10,000 bucks after the market crashed in 1929 and you held it until today, you'd have made a lot more money than if you had it in gold. So you have to think about what you're really talking about with your portfolio. Um, Preserving your purchasing power is not the same thing as growing your portfolio. And plus, think about your time horizon here. If you had it in 1929, 2024, I mean, who was buying 10 gold bars in 1929 who's still sticking around today to rub it in our face? You know, just you see these things and it's like I don't know what the point is. Like, what are you trying to tell me? But in terms of putting capital to work, what you want to do, and we're going to look at data about how markets perform in the latter half of August and into September and beyond. But if we're talking about putting capital to work, you want to have a strategy. And in terms of your model portfolio, sure, you should have some precious metals. You know, you should have some gold. You should have some things that are going to perform well if the shit hits the fan here in the stock market, or if if war escalates. But careful when you see these type of things that elicit an emotional response that get you to go out and buy something. What you really want to do is stick to a strategy and rebalance. You can generate some income, sell in some covered calls, for example, or opening up some option spreads, um, taking out a put to go short when markets get to these local highs. You can have a skilled active manager who can do that for you and who can extract value from any type of market. But in general, don't get too excited when you start seeing stuff like this, because it doesn't mean what it's trying to convey. Okay, in the world of politics, like I mentioned at the top, pretty wacky stuff. Let's look on the left here. As of yesterday, Donald Trump expected to win pretty convincingly. I tend to think that will be the outcome, assuming we have a free and fair election. And I'm not going to get into all of that. And, in general, when we're talking about politics, I work in private enterprise, so you can probably guess where my affiliations lie, and I'll just leave it at that. But in terms of polarization, we're up there, man. And I've been thinking about these people who are calling for chaos, or these people that are calling for a fourth turning. You could see the demographics or the socio-political stuff really rear its ugly head, and the response mechanism is just going to be to flood the system with money. So you might see this weird disconnect where it's like society is boiling over, but the stock market is like a 10,000 S&P. So I don't know. It's such a weird thing. But I just want to bring this up, and then I'm going to move on before I get in trouble. Anyone who can look at this chart about their revenue increasing substantially while their profit decreases, and this is Walmart, and who is going to talk to me about corporate greed and price gouging. Boy, how do I put this? Well, I just wish that they would do the right thing for this country. Say, never mind, I was wrong. I didn't understand basic economic theory, and they would politely, patriotically bow out of public office, because that is ridiculous. Okay, and into the public markets. This is from Wayne Whaley. Give him a follow over on Twitter. He puts out fantastic stuff. So he has assembled 22 years that had relatively similar readings to the market we have in 2024. 22 years out of the last 50. And in those 22 years, here is the data from August 27th to September 9th. Market was up 15 times, down 7 times. From the 9th to the 15th of September, down 13 times, up 9 times. Then we have strength from the 15th to the 23rd. Again, 15 up, 7 down. Weak in the back end. Up 6 times, down 16 times. And the change in September overall, 11 times that we were up, 11 times that we were down. But these reads are pretty extreme. So watch out for this because down 3.5%, down 8.5%, up 5 and 5.3, up 6.25. So you have to be skilled here in how you're navigating. I typically wouldn't advocate for rebalancing 3 or 4 times in a month, but this might be a good month to sell covered calls on the 9th. Close those positions for the 15th, reopen them, or open up a put hedge, or do something. I would think this is a good month for an option strategy, or it could be a good month to rebalance, take some risk off ahead of the election. But in any event, use data instead of headlines and people just giving you goofy goofball advice. These pictures got a little bit grainy. I apologize for that. But whatever happens politically, whatever happens macroeconomically, if the earnings revisions are trending upward, then stock price is going to follow. That's really how that works. And I wouldn't look too far into it. But earnings are up, revenues are up, profit margins are expanding, and interest rates are set to come down. So the table is set for a delicious meal. And at the same time, the largest inflow to gold funds in 4 weeks that we have in quite some time, not since the COVID crash. So people keep wanting to say that's, stocks are going to be up, gold's going to be down, or stocks are going to go down and then gold's going to come up. There can be scenarios where liquidity conditions are increasing. The monetary supply is expanding and it goes everywhere, especially if corporate profit margins are up. And if the dollar is weakening, then you're going to see it come into gold. So, hey, sometimes there can be multiple winners. Another grainy one. But the point here, this was the first quarter in nearly 2 years where the rest of the S&P 500 index was expanding their earnings and profits faster than the Magnificent Seven. So if you're a market bull and you see this breadth of the market expanding, then you certainly like what you see here. But in terms of what's going to drive the market this week, I think this is pretty straightforward. We have Nvidia's earnings after close on Wednesday, and if they have another blowout quarter and they beat earnings per share, they beat on revenues, and they can beat on their guidance, then boy, we're gonna almost certainly make another all-time high. And there's some other interesting ones out there, depending how you pick your poison. But obviously, Nvidia, as Nvidia goes, so too will the market. So that's all for this week, guys. Let me know what you think in the comments down below, or reach out on Twitter, LinkedIn, email, whatever. And yeah, let's put some money to work and see what we can do. All right, folks, take care.